Welcome to Illuminati Silver. We tell you the truth about silver. Today is Sunday, the 20th of June 2021. And last week, we saw the US dollar value rise and gold and silver prices crash. Today, though, we're looking at emerging markets and what some of them are doing to their currencies, which could very well mean that US dollar strength may prove to be a short-term phenomena, especially if countries like the United Kingdom follow suit. And then we could see a reversal in gold and silver prices as a result. However, we also point out that there may just be a short-term window where gold and silver prices thrive before US and international interest rates really do start to move higher, so that the opportunity cost of holding these metals then increase compared to other interest-yielding assets. So before we take a look, just a quick mention that the last few days we've produced a number of very pertinent videos to do with the gold and silver price crash, and we've listed those below for ease of reference. So let's now have a look what's going on in the emerging markets. Now, in today's Bloomberg article, headline, Emerging Market Bulls Pin Currency Hopes on Hawks Outpacing Fed, we notice that Bloomberg are, to some degree, actually reiterating what we said in our weekly update yesterday, and also in the video that we produced on Friday, Has the Fed Made an Error? Now let's just have a quick look at this article. It's quite interesting, but focusing on emerging markets, and we'll cover why emerging markets are important in a few seconds. Emerging market currencies hit by a hawkish Federal Reserve could soon regain their record run against the dollar on expectations that developing central banks may outpace their US counterpart in policy tightening. The currencies of Brazil, Russia, the Czech Republic, South Africa and Hungary, countries that delivered multiple rate hikes or are expected to do so soon, are retaining quarterly gains and outperforming peers. More may join their ranks, with tightening expectations growing for countries including Chile and South Africa as economic activity and inflation roar back from a pandemic-driven slump. In comparison, the Fed has signaled it's likely to lift interest rates only in 2023. Now, interestingly, we commented that the markets really reacted badly to what the Fed stated last Wednesday, when Jerome Powell made it very clear they were not going to raise rates, but the majority of Fed governors believe that they should be raised twice in 2023, and a fair number of those believed that 2022 could not be ruled out for one rate hike. In addition, they've agreed to continue with their $120 billion a month bond buying program, of which essentially $80 billion are in treasuries and $40 billion in mortgage-backed securities. But they did say that they will be discussing when to consider tapering. However, we've made it very clear that in our view that's going to be months away. So even though the Fed has actually not done anything particularly other than say we're going to consider these things, they were regarded as hawkish, and yet we are beginning to see that other countries have already started raising rates. So how hawkish is the Fed? And I think you'll find in the video that we produced, we made it very clear, not hawkish at all. And this may be by design. Now, while recent dollar gains have stalled the momentum in emerging market currencies, that picture could change once the greenback support from positioning shift fades, according to the Bank of Singapore Limited and JP Morgan Asset Management. Emerging market central banks are set to begin raising interest rates well before the Fed, said Mansoor Mohiuddin, chief economist at Bank of Singapore Limited. Over the summer, lower volatility may induce investors to put on seasonal carry trades again to the benefit of higher yielding emerging market currencies. US financial conditions are closely correlated with demand for risk assets, including emerging market stocks and currencies. While taper talk has been the focus of investors' concerns, they should be watching for signs of tightening financial conditions, which could trigger a sell-off, according to Niels Heinecke, a strategist at Nedbank Group Limited in Johannesburg. That's not happening yet. US conditions still near the loosest on record, according to Goldman Sachs US Financial Conditions Index. And while gauges of emerging market stocks and currencies have pulled back from all-time highs, they're still well up this quarter, and you can see that in this graph here. The black line represents the US Financial Conditions Index, and the red, the MSCI Emerging Markets Index. Now, with the Fed unlikely to hike in 2021 or 2022, monetary and financial conditions should remain easy for some time, said Didier Lambert, JP Morgan Asset Management's lead portfolio manager for emerging market fixed income. Emerging market central banks able to rein in inflation expectations in a credible way, such as Russia, Czech Republic or Brazil, may see greater demand for their currencies. Now, the reason for that is simply because they're going to be putting interest rates up. And so the currency strengthens usually as a result of that. So it becomes more attractive on the foreign exchange markets. Whether, of course, people regard the Russian ruble as that attractive in view of the political environment is another matter. But nevertheless, this makes economic sense. Now, while some commodities took a hit after the Fed's latest rate signal, others remain supportive of emerging market currencies linked to raw material prices. Raw materials like copper, coal and iron ore hit all-time highs last month, with a rebound in the world's largest economies stoking demand for metals and energy when supplies are still constrained. And of course, this then feeds into metals such as silver, which have taken an enormous hammering, down $2 last week, when global demand on the industrial side should actually be improving. That's prompting Aberdeen Asset Management to take advantage of any weakness to add to its bullish bets on commodity-linked currencies such as the Brazilian real, as well as the Chilean and Colombian peso. If anything, this is ratification that global growth is strong, and so is the demand for commodities, said Edwin Gutierrez, head of emerging market sovereign debt at Aberdeen in London. But let's see how much of a shakeout there is in those. JP Morgan Asset Management plans to use any market volatility to invest in most emerging market currencies that will benefit from a cyclical recovery and in selective high-yielding securities. Bullish positions in developing currencies aren't overextended, suggesting the potential losses from a stronger dollar will be limited, said Lambert. The shift towards tighter monetary policy in developing nations isn't uniform, however. Some are continuing to support growth as the coronavirus continues to spread or a new wave of cases emerges. And this is really important because many emerging markets have been badly hit, as all markets have, by the coronavirus, but they don't normally have the financial strength in the main to ride the storm, as it were. And so a number will be keeping its currency levels as low as they can to help exports and to make inward investment attractive. Central banks in Thailand and the Philippines look set to keep interest rates on hold this week as the region battles persistent coronavirus outbreaks with only a fraction of the population vaccinated. Poland wants to keep monetary policy loose until the economic rebound is well underway, despite surging inflation. And this is where the competition now between nations is going to occur. We're going to have increasing inflation in certain countries who will dampen down on that by raising rates quite rapidly, while others will allow it to continue in order to keep loose monetary policy and increasing investment into their industries and enabling banks to lend to those industries until recovery is well on its way. The risk, of course, is that if they leave it too long, then they could find themselves with a currency collapse. Now that means investors should be looking for relative value trades rather than buying the basket, according to the Bank of America Securities, which favours Poland's zloty over other Central and Eastern European currencies, given cheaper valuations and a still relatively dovish central bank, giving it more scope to reprice when they turn hawkish, strategists led by David Horner said in a report. So as you can see, again, short term may be at a disadvantage or advantage, and then it can lead into an alternative scenario. The Brazilian real has been the top performer among emerging market currencies this month, followed by commodity-linked peers such as Russia's ruble and Colombia's peso. The forint, zloty and koruna have underperformed. Brazil's monetary authority hiked its key interest rate by 75 basis points and opened the door to even bigger increases on Wednesday amid surging inflation forecasts. The nation is among the first to increase its key rate to pre-pandemic levels, taking a more aggressive stance to battle inflationary pressures. And this is the dilemma the US is going to have. With the incredibly high level of national debt, it knows that its ability to raise rates to some degree is limited. They can raise them, rest assured of that, because at the end of the day they can always print more money in the short term. Long term it'll be disastrous, but short term they can do it. But equally, they cannot do it without reference to the fact that that interest has to somehow be repaid. And of course, their money printing is already arguably out of control. Why exacerbate the problem even further? Brazil is probably the clearest example of a combination of better growth prospects, reduced political noise, more hawkish central bank and undervalued currency to justify its recent outperformance, the BofA, or Bank of America, strategists wrote. Now, I won't read the rest of this, but what I will cover, just very briefly, is that Hungary's central bank on Tuesday is poised to start one of the region's first monetary tightening cycles to combat the fastest inflation in the European Union. On Wednesday, the Czech central bank is predicted by almost all economists to follow suit with a quarter-point hike to 0.5%. Thailand and the Philippines will probably keep borrowing costs unchanged on Wednesday and Thursday, respectively. China's one-year loan prime rate, the reference rate for bank loans to companies, will likely remain at 3.85%, according to a Bloomberg News survey ahead of data due on Monday. Mexico's central bank is expected to leave its key interest rate steady for a fourth month on Thursday, and Brazil's central bank will release minutes from its most recent policy meeting on Tuesday, which may offer detail on the 75 basis point Selic increase. So it's really quite important to consider where international investment monies will go, where foreign exchange investments will go, and to what extent the emerging markets are actually handling coming out of this pandemic crisis. As far as we are concerned, the dollar is strengthening at the moment, until other nations actually start raising their rates. Presently, they're using what we call verbiage to influence markets. But as we all know, actions speak louder than words. So do not expect the dollar strength to continue too long into the future, though it may very well do so very short term. That means, therefore, maybe more pressure on gold and silver short term, but it will start to unravel until America does raise rates again. But we all know that's not going to happen in 2021, and it's extremely unlikely to happen unless inflation really soars higher than anything that they predict in 2022. Hope that wasn't too complex. We try to simplify these things as much as possible. At the end of the day, things are looking good for gold and silver in the medium term, even though they may be looking not so good in the very short term. The dilemma, of course, is once interest rates do start to rise, then competing funds for interest-bearing securities will potentially put gold and silver under pressure. So there may be an intervening time between now and when the central bank does raise rates. There may be an opportunity to maximize one's investment in gold and silver, and maybe then find it an appropriate time to come out. It's all down to inflation. Thank you for listening. Please, if you like what we've covered today, give us a thumbs up. By all means, subscribe, press the bell sign, and let's hear your comments below. Disclaimer. Illuminati silver owners come from a background of banking, international wealth management and economics. Having now retired from these worlds, we are not qualified to give investment advice. Therefore, this and other productions must not be deemed to be giving such advice and merely represent the personal views of its owners.